Welcome to a new portfolio management topic where we examine the relationships between economics and the applicable discount rates for investment markets. For this first lesson, we begin with the real risk-free rate. We'll have an overview of this topic and learn what the intertemporal rate of substitution is. We'll also study the economic factors that influence the real risk-free rate. This can be a rather intense lesson as there are many unfamiliar concepts, so do buckle up as we dive right in. By now, you should be very familiar with the present value model, which we've used for the valuation of fixed income and equity investments. The current price of an asset should reflect the sum of the PV of its expected future cash flows. We can think of the discount rate as having three distinct components: the real risk-free rate, the expected inflation rate, and a risk premium reflecting the uncertainty about the cash flow. Depending on the asset class, this third component can manifest in the form of a premium for inflation uncertainty, credit risk premium, equity premium, and/or liquidity premium in some cases. A major purpose of this topic is to identify the relationship between these elements of the discount rate in the market and the underlying economy. But before we go into that, it is important to understand that we are more interested in studying the change in economic expectations rather than the change in economic factor itself. This is because information that has been anticipated is already reflected in asset prices, but information that is different from what was expected would result in adjustment of expectation, thus causing the asset price to adjust accordingly. For example, news of a positive GDP growth rate surprise for the past quarter may not cause stocks to rise if investors still have the same expectation for next year's GDP. However, if this news raises next year's GDP growth expectation, stock prices should increase to reflect such a change in expectations. Now, let's begin with our study on how economic expectations affect real risk-free interest rates. To simplify our arguments, let's first imagine a world without inflation. Without inflation, the only premium that an investor should expect from purchasing a risk-free investment is the opportunity cost of lower consumption today. In other words, by buying a financial asset, an investor defers some current consumption. To convince the investor to forego spending $1 today, the investment should promise a return to compensate the investor for the opportunity cost. The difficult part is to determine this amount of return. The CFA curriculum explains this using utility theory. Utility tends to increase with consumption, but this relationship is not linear. Rather, it should exhibit diminishing increase in utility as consumption increases. For someone that typically spends $100 for a meal, spending an additional $1 for a piece of bread will hardly increase his satisfaction from that meal. But to someone who spends $3 on a basic meal, spending that extra $1 for a piece of bread can substantially increase satisfaction for that meal. We can say that the marginal utility of consumption at higher levels of consumption is lower than at lower levels of consumption. The utility curve may differ if we consider the consumption is to be made today or in the future. All things equal, humans always prefer current consumption, so marginal utility of current consumption should be higher than the marginal utility of future consumption. The intertemporal rate of substitution is the marginal utility of future consumption of 1 unit divided by the marginal utility of current consumption of 1 unit. This represents a person's trade-off between real consumption now and real consumption in the future. Since future utility has lower marginal utility, the intertemporal rate of substitution, denoted by MT, is always lower than 1. This figure is important in helping us figure out how much return would convince a person to invest for the future than to spend it today. Let's say the investment is a risk-free zero-coupon bond which matures at $1 1 year later. If the investor, at his current level of income and consumption, has a 1-year intertemporal rate of 0.96, that is, $1 1 year later would only buy him the equivalent utility of what 96 cents buys him today. In other words, he would be indifferent between spending 96 cents today and investing that 96 cents for a guaranteed $1 1 year later, as both amount to the same amount of utility. Now let's test your understanding. If the bond is priced at 95 cents today, would the investor buy the bond? Your answer should be to invest in the bond, as spending 95 cents today would buy him less utility than the utility he can buy 1 year later if he invests the 95 cents. In fact, let's say the investor has $1,000 income to decide between spending and investing. He'll keep buying until a point where his intertemporal rate of substitution is equal to the bond price, at which point he'll stop buying. In general, you should understand that the intertemporal rate of substitution is always an estimate, because it's not possible to know for certain the income or consumption level in the future, even in the absence of inflation. And even for a risk-free instrument where the cash flow is certain, it is still uncertain as the utility that'll be derived from it is not known today. Given these uncertainties, the investor must make the decision today based on his expectations of future circumstances. Thus, if the investor wants to consider a $1 zero coupon bond that matures at time t, the price that he would be indifferent between consumption and investment would be the expectation of the marginal willingness to trade consumption. And with that, the expression to calculate the real risk-free rate should be as follows. Remember this expression, as we will come back to this. If we assume that all investors are essentially making investment decisions based on the trade-off between current and future consumption, some will want to sell their bonds to fund additional current consumption, whereas others will want to buy bonds and defer some additional consumption until the future. This process would continue until all investors' willingness to invest converges on a single equilibrium value so that the equation is true for all individuals and the market price of the bond is determined. Based on the market price of the risk-free bond, we can determine the real risk-free rate, assuming there is no inflation. Determining the interest rate from the market price of a bond is easy. If the investment horizon for this bond is 1 year and the payoff then is $1, the return on this bond can be written as the future payoff minus the current payment relative to the current payment. We can express it in terms of the expected MT at this point. So, for our example, let's say the intertemporal rate of substitution for the aggregate market participants is 0.95. The 1-year real risk-free rate is therefore 5.26%. If you look at the equation carefully, you'll observe that the marginal utility of current consumption and the intertemporal rate are at the denominator. This relationship tells us that the higher the utility investors attach for current consumption relative to future consumption, the higher the real risk-free rate. This makes sense, as investments need to give higher risk-free returns in order to convince people to invest rather than to spend the money. Remember this, there is a positive relationship between the utility for current consumption and the real risk-free rate, but the relationship between the intertemporal rate and the real risk-free rate is inverse. Before we go further, it's important to understand the effect of economic expectations on the aggregate intertemporal rate of substitution of all market participants, and consequently the real risk-free rate. When investors expect economic growth to improve, they expect higher future incomes, so the marginal utility of future consumption decreases. The intertemporal rate of substitution decreases, meaning that people are less inclined to invest for the future. The real risk-free rate of interest should consequently increase. Conversely, investors expecting worse times ahead would prefer to increase future consumption by reducing current consumption and saving more, consequently lowering the real rate. At this juncture, remember this key point, as we're going to come back here later. If GDP growth is expected to improve, the real risk-free rate should increase. If GDP growth is expected to be poorer, the real risk-free rate should decrease. Unfortunately, we're not done yet, as there is another aspect to consider. That is the risk aversion of investors. Based on the utility curve, investors experience a larger loss of utility for a loss in wealth, as compared to a gain in utility for an equivalent gain in wealth. This may explain risk aversion in investors. The degree of risk aversion can vary among different types of investors. For a wealthier investor, the marginal loss of utility is lower than that for a poorer investor. Accordingly, wealthier investors should be less risk-averse and more willing to take risk relative to poorer investors. However, the marginal gain in utility of holding risky assets declines as an investor holds more investment assets, so wealthy investors may not be inclined to invest more despite being less risk-averse. As such, when the markets are in equilibrium, wealthy and poorer investors would have the same willingness to invest in risky assets. You may be wondering, why would there be risk aversion when we're currently looking at risk-free investments? You're right if we're looking at a $1 risk-free zero coupon bond that matures at time t. There is no uncertainty in cash flow since the bond simply pays out its $1 maturity value, so the price today is simply the intertemporal rate for the period t. This was what we went through earlier. There is no risk aversion here. However, if an investor's time frame is t, but the zero coupon bond matures after time t, there is some degree of uncertainty in the value of the bond at time t. Even though it is a risk-free investment, its value at time t is dependent on the risk-free rate at that point, which is uncertain. The price at which an investor would be indifferent to spending or investing is the expectation of the payoff at time t times the intertemporal rate of substitution for time t. You do not need to know the derivation, but this expression can be broken down into this form, where this first term is the PV of the expected cash flow discounted at the risk-free rate, and this covariance term is the discount for the uncertainty in cash flow. For a one-period default-free bond, the covariance term is 0 because there is no uncertainty. In general, with risk-averse investors, the covariance term for most risky assets is expected to be negative. This is because when the expected future price of the investment is high, the marginal utility of future consumption is low, as we've observed from the utility curve. This relationship also implies that since the covariance term is negative, the current price should be lower than what is expected, so the expected return is higher than the case where there is no risk aversion. Earlier, we've determined the expression for the real rate based on the assumption of no risk aversion, which is dependent only on the trade-off between current and future assumption. The higher expected return in the case with risk aversion is due to a positive risk premium that investors demand for bearing the risk that comes with uncertain cash flows. The higher this uncertainty, the higher is the required real risk-free rate. We can extend this argument to the wider economy. If there is no uncertainty in GDP growth forecast, then an increase in real GDP growth should lead to an increase in the real default-free rate, as we've learned earlier. But in practice, GDP growth cannot be perfectly anticipated. Under these uncertain circumstances, the real risk-free rate will still be positively related to the expected growth rate of GDP, but additionally, it'll be positively related to the expected volatility of GDP growth. There are two practical implications of this analysis for the values of real risk-free interest rates. An economy with higher trend real economic growth, other things being equal, should have higher real default-free interest rates than an economy with lower trend growth. And other things being equal, real interest rates are higher in an economy in which GDP growth is more volatile than in an economy in which growth is more stable. To summarize, if you cannot understand anything from this lesson, make sure you at least remember this key takeaway. The willingness of investors to substitute future wealth for current consumption will be inversely related to the expectation in real GDP growth, which in turn have an inverse relationship with the real risk-free rate. When investors expect future GDP to be high, they'll be inclined to spend more and save less, so the real risk-free rate should increase to provide a higher compensation to investors who save. The relationship between the expected GDP growth and real risk-free rate is positive. In the presence of risk aversion, investors demand a risk premium for the uncertainty in cash flows, which is positively related to the volatility of real GDP growth. All these are made under the assumption of no inflation. In the next lesson, we'll lift this assumption as we move on to study the nominal risk-free rate. See you again.